As of this moment, BigBear.ai Holdings, ticker BBAI, is trading at $7.22 per share, down 3.60%, a drop of 27 cents on the day. Now, on the surface, a nearly 4% dip for a volatile small-cap AI stock seems like just another Tuesday in this market. Many will see that red arrow and immediately attribute it to broad sector weakness or simple profit-taking after the stock's impressive recent run. That's the easy surface-level explanation. The expectation is that stocks like this are just chaotic, but the reality of today's move is far more specific. This isn't just random noise. We're seeing a calculated reduction in exposure from several mid-sized tech funds that entered the name weeks ago. The trading volume, while not explosive, is showing a consistent pattern of block sales at key technical levels, suggesting a coordinated, albeit quiet, exit. This isn't panic selling, it's methodical. This changes the entire picture from one of random volatility to one of strategic repositioning by informed players, and that's a distinction every investor needs to understand. The common belief surrounding BigBear.ai is straightforward. It's a direct play on the integration of artificial intelligence within the U.S. government, specifically the defense and intelligence communities. The narrative is that these are stable, high-value, long-term contracts that are insulated from typical economic cycles. Investors buy BBAI with the expectation that as the government continues to modernize its capabilities, BigBear.ai will be a prime beneficiary, steadily growing its revenue base on the back of federal spending. It's seen as a pick-and-shovel play on national security AI, and for many, that's where the analysis stops. It feels safe, almost patriotic. But this view dangerously oversimplifies the situation. The deeper reality is that government contract flow is anything but smooth. It's lumpy, subject to political headwinds, and intensely competitive. A delay in budget approvals or a competitor underbidding on a key contract renewal could create an air pocket in revenue that the market is simply not pricing in. Furthermore, the company's valuation has often been driven more by the general hype around names like Nvidia stock than by its own specific contract wins, creating a serious potential for valuation disconnect. Let's dissect the recent price action to see this disconnect in action. The stock experienced a massive surge a few weeks back, not on a new company-altering contract announcement, but largely on sentiment. It was swept up in the broader AI enthusiasm. Traders using platforms known for high-speed execution, like the Interactive Brokers trading platform, likely amplified this momentum. However, following that peak, we've seen a slow bleed. Today's 3.60% drop is a continuation of that trend. What's happening is that the short-term momentum traders are gone, and now the fundamental questions are coming back to the forefront. Is the current revenue run rate enough to justify the market cap? The stock is currently wrestling with a key technical support level. A break below this could trigger further automated selling from algorithmic funds and stop-loss orders placed by retail investors on their Fidelity mobile app or Robinhood app. This is why understanding the flow is so critical. The expectation was a continuous climb on AI hype. The reality is a technical battleground where the company's fundamentals are being put to the test. Many people simply looking for investment help or setting up a self-investing account might see the AI label and jump in, without appreciating these underlying mechanics. It's a very different type of investment than, say, buying blue-chip staples like Apple stock. The company itself, BigBear.ai, provides decision intelligence solutions. In plain English, they build complex AI systems that take in massive amounts of data and provide analytics and predictive models to help organizations make better decisions. Their bread and butter has been the public sector. Think of analyzing satellite imagery for the Department of Defense or predicting logistical bottlenecks for a federal agency. This is highly specialized work. Their business model relies on securing and executing these large, often multi-year contracts. A look at their past reports shows a clear dependency on a handful of significant government clients. This is both a strength and a weakness. It provides a certain level of revenue predictability once a contract is won, but it also creates immense concentration risk. The company has been making a concerted effort to expand into the commercial sector, targeting industries like manufacturing, logistics, and energy. This is an absolute necessity for its long-term health. It cannot rely solely on the federal government. But this is where the story gets complicated. In the commercial space, they aren't just competing with other small government contractors, they're up against enterprise software giants and a sea of venture-backed startups. It's a completely different sales cycle and competitive landscape. The market expects a smooth transition and growth in this commercial segment, but the reality is likely to be a tough, expensive, and prolonged fight for market share. An investor using a managed product like Schwab Intelligent Portfolios would likely have very little exposure to this kind of single-stock risk, highlighting the difference in strategy between passive and active online investing. Looking at the financials, the story is one of a company in transition. Revenue has been growing, but profitability remains elusive. Like many high-growth tech firms, they are investing heavily in research, development, and sales to capture market share. This cash burn is a key metric that serious investors are watching. The question is whether they can achieve scale and operating leverage before they need to raise additional capital, which could dilute existing shareholders. The reaction to their last earnings report was a perfect example of the market's schizophrenic view of the company. The numbers themselves were largely in line with expectations, but the guidance caused a stir. Any hint that the pipeline of new contracts isn't growing as rapidly as hoped sends shivers through the investor base. People using Sophie investing tools or other investing sites to track analyst ratings would have seen a flurry of adjustments following that report, with some analysts reiterating their buy ratings based on the long-term potential, while others downgraded based on near-term uncertainties. For anyone engaged in online investing, it's a classic case of a stock story where the narrative is just as important as the numbers. Comment below what you believe is the single biggest risk for Big Bear over the next 12 months. Is it government budget cuts, failure to penetrate the commercial market, or competition from larger tech players? Looking forward, the path for BigBear.ai presents a few distinct possibilities. In the bullish scenario, the company secures another major multi-hundred-million-dollar government contract. A win of that magnitude would validate their technological edge and provide the capital needed to aggressively fund their commercial expansion. If they can simultaneously announce a significant client win in the commercial space, say a Fortune 500 manufacturing company, it would signal that their diversification strategy is working. This would almost certainly cause the stock to break out of its current range and attract a new wave of institutional ownership through platforms like Fidelity Wealth Management or from funds that build their own Fidelity ETFs. This is the outcome that current shareholders are banking on. The expectation is that the technology is superior and will inevitably win out. However, the bearish reality must be considered. The risk is that the contract pipeline remains lumpy, and the commercial push stalls. If federal spending priorities shift, or if a competitor with a slightly different technological approach starts winning key bids, BigBear.ai could find itself in a difficult spot. A quarter of flat or declining revenue would be punished severely by the market, especially given its current valuation, which is predicated on high growth. In this scenario, the stock could retest its prior lows as growth-oriented investors flee. The company's access to capital could become more constrained, forcing difficult decisions about spending. This isn't to say the company would fail, but the path forward would be much more arduous. Active traders using an individual brokerage account with Fidelity Investments or Interactive Brokers would need to be nimble, as the swings could be dramatic. Even users of more streamlined platforms like Sophie Invest or Robinhood stock trading would feel the impact of such a sentiment shift. In conclusion, the 3.60% drop in Big Bear today is far from meaningless noise. It's a symptom of a larger reevaluation taking place. The market's initial simple expectation of a straightforward AI growth story fueled by government spending is colliding with the complex reality of contract dependency, intense competition, and the difficult road to profitability. The stock is not a simple bet on artificial intelligence. It's a bet on this specific company's ability to navigate the treacherous waters of both federal procurement and the commercial enterprise software market. The disconnect between the broad optimistic narrative and the granular challenging reality is where both the risk and the opportunity lie. Understanding this distinction is what separates a speculative guess from an informed investment decision. This content is for educational purposes only and not financial advice. Always do your own research and consult a licensed financial advisor before investing.